Financial history is marked by cycles of scarcity and perceived abundance. Every generation seeks the mechanism, the structural advantage that promises to defy the laws of economic gravity. For a brief period beginning in 2020, one specific corporate strategy emerged, promising continuous, recursive growth, independent of traditional business operations. It was the rise of the crypto treasury company. Before this transformation, MicroStrategy was a decades-old business intelligence software firm. Its stability rested on predictable, if unspectacular, enterprise revenues. Its treasury held cash reserves, managed against operational need and market risk. This was the established order: value derived from cash flow, capital raised through traditional debt or equity tied to earnings. But the system was showing weakness. Low interest rates and rapid technological shifts had normalized the pursuit of outsized returns, blurring the lines between corporate finance and pure speculation. When the firm announced it would convert its balance sheet into a massive holding of Bitcoin, the shift was not merely an investment, it was a total restructuring of the company's DNA. The stated goal was to hedge against currency devaluation. The immediate consequence was the creation of a powerful new financial machine. The firm became a structurally leveraged investment vehicle, separating its valuation almost entirely from its foundational software revenues. A new model was born, relying not on profit, but on the exploitation of market perception.
The success of the model hinged on a single crucial inefficiency: the market premium. For years, MicroStrategy stock consistently traded at 2 or even 3 times its net asset value, a value calculated simply as the sum of its Bitcoin holdings and its core software business, minus its debt. This premium was an arbitrage of perception. Investors, eager for leveraged exposure to the crypto asset without the regulatory complexity or margin call risk of direct leverage, treated the stock as a superior investment vehicle. They were willing to pay a $2 stock price for what was effectively $1 of underlying Bitcoin. This gap allowed for the recursive financing loop. The company could issue new common stock, selling it at the elevated market price. Because they received $2 for every $1 of Bitcoin exposure they added to the balance sheet, the firm could immediately use those proceeds to buy significantly more Bitcoin. This process was termed accretive dilution. While it diluted the number of outstanding shares, it increased the Bitcoin per share holdings of existing investors. As long as the market premium persisted, the mechanism functioned perfectly. Every capital raise funded more reserve acquisition, which in turn drove the stock price higher, fueling the next capital raise. The only constraint was market demand.
The engine of this recursion was debt. The stock's high volatility, driven by its crypto exposure, was crucial. Volatility increases the value of options, and MicroStrategy used this inherent instability to issue low or zero coupon convertible bonds. These bonds offered low cash interest payments, but allowed investors the option to convert them into stock if the price rose sharply. For large institutional investors, these bonds were highly attractive, not for the yield, but for the complex hedging opportunities they unlocked. Hedge funds engaged in convertible bond arbitrage, a strategy known as gamma trading. They would buy the bond and simultaneously short sell the underlying stock on a precisely calculated ratio. The goal was market neutrality, profiting not from the direction of the stock, but from its constant movement, its high volatility. This complex financial symbiosis allowed MicroStrategy to raise billions cheaply. But the strategy was not without mandatory cost. To ensure the loyalty of early investors and fund the acquisitions, the company also issued classes of high-coupon preferred stock, carrying fixed liabilities like the 10.00% Series A perpetual strife preferred stock. These obligations were absolute. The company had guaranteed high fiat dividends that had to be serviced, regardless of the price of the core reserve asset.
By 2024, the structural pressure began to mount. The recursive model was fundamentally contingent on 2 things: sustained asset appreciation, and the continuation of the market premium. When the crypto market entered a period of stress in late 2025, the vulnerability of the system was exposed. The stock, being a leveraged vehicle, experienced significantly higher losses than the underlying Bitcoin itself. For many firms adopting the model, the leverage cut both ways. When MicroStrategy's premium to NAV began to evaporate, the ability to fund Bitcoin purchases through accretive stock sales vanished. The mechanism ceased to be a glitch and became a standard, expensive liability. For the copycat companies, the stress was immediate and existential. Metaplanet saw its stock price plunge by nearly 80%. These firms were forced to confront the harsh reality of their debt structures, which were denominated in fiat currency but backed by volatile digital reserves. This period signaled the return of financial gravity. The market was no longer willing to pay a massive premium for a leveraged asset holding, forcing companies to revert to traditional capital management strategies based on liquidity, not speculation.
The critical confrontation was the realization that pure Bitcoin liquidity was insufficient to manage mandatory fiat obligations. The structure demanded dollars to service debt and preferred dividends. Sequans Communications, a firm that had mirrored the model, was among the first to break ranks. In a clear sign of systemic failure, Sequans was forced to sell approximately $100 million worth of its Bitcoin reserves to repurchase convertible bonds and cut its outstanding debt. The sacred reserve, the very asset upon which their valuation was built, had to be liquidated to satisfy traditional credit obligations. MicroStrategy, facing its own substantial fixed costs, including those high-cost preferred dividends, made a decisive shift. It established a substantial $1.44 billion US dollar reserve. This action was an acknowledgement that the maximalist Bitcoin-only treasury was untenable. Fiat liquidity, the supposed weakness they had sought to escape, was now the necessary anchor for corporate solvency. This was the definitive turning point. The cycle of recursively raising cheap capital to buy more Bitcoin had ended. The company was now selling equity not to expand its Bitcoin holdings, but increasingly to service interest and dividend payments on liabilities assumed during the boom.
The phase of unlimited recursion had concluded. The structural flaw of the crypto treasury model was laid bare. It functioned flawlessly only when the premium and the underlying asset price were rising faster than the company's mandatory cost of capital. Once that differential narrowed, the high-interest preferred stock became a heavy anchor. The collateral damage was profound. Leveraged single-stock ETFs tied to MicroStrategy, vehicles designed to amplify daily movements, collectively lost over $1 billion for retail investors, demonstrating the catastrophic impact of combining derivatives with high volatility and structural leverage. MicroStrategy bought time with its dollar reserve, stabilizing its operations for the near term, but the fundamental tension remains unresolved. The company faces a substantial maturity of convertible debt beginning in 2027. If market conditions do not provide relief, the critical question becomes, will MicroStrategy be forced to sell its massive Bitcoin holdings to refinance its obligations? The story of the crypto treasury company is a specific instance of a timeless financial pattern. Power emerges in periods of disorder, creating systems that rely on the market's enthusiasm. But systems dependent on perceived scarcity and perpetual growth must eventually conform to the logic of credit and cash flow. The financial structure always demands accountability. The arbitrage of perception may end. The debt remains.